insurance. Long-term care, LTC, includes many different types of care given in a variety of places. As the U.S. population ages and life expectancies increase, the need for this form of medical care continues to grow. What is long-term care insurance? Long-term care insurance protects against the cost of medical services associated with long-term care, including diagnostic services, preventive services, therapeutic services, curative services, treatment and rehabilitative services, personal care. The need for LTC insurance. The annual costs for long-term care services are expensive everywhere. Depending on the type of service rendered, the annual median cost in the United States ranges from about $20,000 to over $100,000. Medicare provides limited long-term care coverage. It covers the first 100 days of care in a skilled nursing home facility and requires that a person first be hospitalized. A Medicare supplement policy covers the daily co-payments for nursing home expenses, but not beyond Medicare's 100-day benefit period. Medicaid also covers extended nursing home costs. However, to qualify for these benefits, a person must spend down personal assets to almost poverty levels. Therefore, LTC insurance helps seniors by giving them the freedom to choose where they receive their long-term care, assurance that they will not have to spend down their assets to qualify for benefits. Indemnity versus reimbursement contract. Long-term care insurance contracts are available as indemnity contracts, reimbursement contracts. An indemnity contract pays the full daily benefit even if the cost of the care is less. In this respect, it is like a valued contract. The more common reimbursement contract limits the daily benefit to the actual expense and does not exceed the maximum daily benefit amount that the policy specifies. How LTC protection is issued. Long-term care insurance can be issued to individuals or groups. Group plans are available to employer groups and associations, such as alumni groups. Long-term care insurance can be added to a life insurance policy through an endorsement or rider. Life policy rider. As a life insurance policy rider, an LTC endorsement gives financial support for the costs of medical care, nursing home care, and assisted living care while the insured is alive. An insured is eligible for its benefit when he or she is diagnosed as chronically ill from a medical or cognitive, mental health, condition. If qualifying for a medical reason, the insured must be certified by a doctor as being unable to perform at least 2 activities of daily living, ADLs, for at least 90 days. If for a mental health reason, the insured must prove that his or her health or safety would be at risk without supervision. The insured must be certified within the previous 12 months. Types of LTC insurance benefits. LTC insurance benefits differ by level of care and services provided. In general, LTC insurance policies cover assisted living care, nursing home services, home health care services, hospice care, adult daycare services, residential community living services, respite care services, temporary respite for a family member who is the caregiver. Levels of long-term care. The need for long-term care usually arises when a person's physical or mental condition impairs the ability to function independently. There are 3 levels of long-term care: skilled, intermediate, and custodial. Skilled nursing care. This is continuous, 24-hour care delivered by licensed medical professionals, under the direct supervision of a doctor. This care is usually delivered in a nursing home. Intermediate care. This is ongoing care for a person's condition but is not needed all day. It is delivered by registered nurses, licensed practical nurses, and nurses' aides who are supervised by a doctor. Typically provided to patients who are recovering from acute medical conditions, it is usually delivered in a nursing home. It may also be given in one's home, an assisted living facility, or a community-based center. Custodial care. This care helps a person with daily living activities like bathing, dressing, or eating. While custodial care must be directed and monitored by a licensed physician, it does not need to be administered by skilled professionals and is often given by nurses' aides. It can be given in nursing homes, assisted living facilities, adult daycare centers, respite centers, or a person's home. Eligibility for LTC benefits. An LTC policy provides benefits after the insured meets a benefit trigger as defined in the policy. Benefits are triggered by the insured's inability to perform 2 or more activities of daily living, ADLs. The insured's loss of cognitive ability, such that it limits the ability to care for oneself without help or supervision, cognitive abilities being include the ability to think, reason, perceive, or remember. Medical necessity. Long-term care insurance recognizes 6 activities of daily living: dressing, eating, transferring, such as moving from a bed to a chair, bathing, toileting, personal hygiene, continence, the ability to control urinary and bowel functions. Although early LTC policies required the insured to be hospitalized before benefits were payable, today's policies cannot use prior hospitalization to trigger benefits. Benefit periods and benefit amounts. Once an insured has triggered benefits, the policy payments begin after the insured has satisfied the policy's elimination period, or waiting period. An elimination period is defined in terms of service days or calendar days. With calendar days, a specific number of days must pass before benefits are payable. With service days, only the days on which the insured received care are counted. Example: an LTC policy with a 30 calendar day elimination period pays benefits 30 days after benefits are triggered. An LTC policy with a 30 service day elimination period pays benefits after 30 days of care. Because the insured might not receive care on 30 consecutive days, this elimination period could be more than 30 calendar days. A policy with a longer elimination period costs less than one with a shorter elimination period. Most LTC policies have benefit limits, defined in terms of benefit amount, the dollar amount that will be paid for qualifying care, typically expressed as a daily amount. Benefit period, the length of time for which benefits will be paid. Common benefit periods are 2 to 5 years, though some policies offer lifetime benefits. Benefit amounts are normally flat daily amounts, such as $50, $100, or $200 a day. The policy owner chooses the benefit period and daily benefit amount when applying for the policy. The owner also selects the elimination period, which may be 0 to 365 days. The longer the benefit period and the larger the benefit amount, the higher the premium. A longer elimination period reduces the premium. Pool of money concept. Many LTC insurance policies base total benefits on a pool of money, or bucket of money, concept. They treat the total benefit amount as a sum of money available to cover all types of long-term care for however long the pool lasts. Optional benefits. A person can buy an LTC policy with options and riders that provide more benefits. These cost additional premiums. Popular LTC benefit options and riders are inflation protection, guarantee of insurability, return of premium, non-forfeiture benefit, inflation protection. The cost of long-term care continues to increase. Inflation protection is therefore an important option in LTC policies. Agents are required to tell prospective policy owners that this option is available. Because inflation protection increases benefits to keep pace with inflation, federal law makes it automatic in a policy unless the buyer rejects it in writing. Applicants indicate this rejection on the application. Insureds have 2 options for inflation protection. Simple inflation protection increases the original benefit on a simple interest basis, usually by 5% per year. This option is recommended for insureds in their 60s or older. Compound inflation protection increases the original benefit on a compound interest basis, usually by 5% per year. This option is recommended for insureds younger than age 60. Guarantee of insurability. Also called the Guarantee Purchase Option, GPO, the Guarantee of Insurability option lets the policy owner increase the daily benefit without additional underwriting, regardless of the policy owner's health. This option is available every 2 or 3 years, depending on the contract. If the option is exercised, the premium increases based on the insured's age when the option is exercised. Return of premium. A return of premium rider returns part of the premium paid for the LTC coverage to the insured's estate or to a named beneficiary when the insured dies. The amount of the premium returned is based on whether the insured used the policy's benefits and if so, to what extent. Non-forfeiture benefit. The non-forfeiture benefit rider states that if the policy owner cancels the LTC policy, a minimal amount of paid-up LTC benefits will remain in force. The amount of paid-up coverage is usually equal to the sum of premiums that were paid to fund the policy. This amount forms a pool of money from which the insured can withdraw a daily benefit, subject to the daily limit of the canceled policy. Waiver of premium provision. Most LTC policies have a waiver of premium provision that waives the premiums if the insured becomes eligible for benefits. If it is a standard provision, there is no additional premium. Some policies waive the premium when benefits become payable. Others require that benefits be paid for a specified period, such as 90 days, before premiums are waived. Common LTC policy exclusions. LTC policies exclude certain conditions from coverage. Common exclusions include alcohol and drug dependency, self-inflicted injuries, including attempted suicide, conditions resulting from war, declared or undeclared, conditions arising from criminal activity, injury or illness for which workers' compensation pays benefits. Underwriting considerations. Individual LTC policies are usually available to applicants between ages 40 and 85. Because most LTC insurance is sold to individuals, determining the risk and applicant presence is an important part of issuing the policy. In general, the older the applicant, the higher the premium. Underwriters assess how well and for how long applicants will be able to perform their daily activities without help. All LTC policies must be issued as guaranteed renewable. The insurer must continue coverage for as long as the policy owner pays the premium. Qualified LTC plans. The tax implications of owning LTC insurance are defined by the Health Insurance Portability and Accountability Act of 1996, HIPAA, which created two categories. Tax-qualified LTC policies. Non-tax qualified LTC policies. A tax-qualified LTC policy meets HIPAA requirements for benefits. A non-qualified plan does not meet these requirements. A tax-qualified LTC policy has tax advantages not available to non-qualified policies. However, tax-qualified policies must adhere to requirements not imposed on non-qualified policies. Qualified LTC policy premiums. With a tax-qualified LTC plan, premiums are a qualifying medical expense for federal income tax purposes. Subject to limits, they may be added to other out-of-pocket medical expenses in qualifying for a medical expense deduction. The amount of premium that may be deducted is subject to maximum limits based on the taxpayer's age. Please pause the audio and review the table. Benefits. LTC insurance benefits that reimburse long-term care expenses are not subject to federal income taxation. However, these benefits are subject to a daily limit. This limit, $390 in 2022, is adjusted annually for inflation. Benefit payments over this limit will be taxed as income unless offset by the taxpayer's unreimbursed long-term care expenses. Benefit triggers. The benefit triggers of a tax-qualified plan are more difficult to meet than those of a non-qualified plan. The table shows the differences between tax-qualified and non-tax-qualified plans. Notice that medical necessity alone does not qualify for benefits under a tax-qualified policy. The insured must meet either the ADL or cognitive impairment requirement to qualify for benefits. Please pause the audio and review the table. LTC insurance suitability. Consumers should evaluate their needs and policy options before buying LTC insurance. Agents should consider the following when determining whether a policy is suitable for a consumer. The consumer should not buy more insurance than is needed. Evaluate income and assets to determine if the consumer can pay some costs of care. Determine if family members can help care for the consumer. The consumer should buy enough insurance. The consumer should not be forced to spend down assets to get complete coverage. Remind the consumer that while it may be possible to reduce coverage in the future, the opposite may not be true, especially if the consumer becomes uninsurable. Examine each policy carefully. No single policy will suit everyone's needs. If the consumer is interested in a policy that only pays for room and board in a care facility, consider other expenses, such as supplies, medications, linens, and other items and services that the policy may not cover. The consumer must be able to afford the LTC policy. For your review, LTC insurance covers the costs of long-term medical and nursing care. LTC benefits include assisted living care and adult daycare services, nursing home and home health care services, hospice care, and respite care for family caregivers. An LTC indemnity policy pays a daily benefit amount regardless of the actual cost. An LTC reimbursement policy pays a daily benefit amount that matches the actual cost. Long-term care consists of skilled nursing care, intermediate care, and custodial care. LTC policy benefits are triggered by the inability to perform 2 or more activities of daily living, ADLs, or the loss of cognitive ability, in a tax-qualified LTC policy, or medical necessity, in a non-tax qualified policy. A tax-qualified LTC policy meets HIPAA requirements for benefits and receives favorable income tax treatment. Prior hospitalization cannot be required for an LTC policy to pay benefits. Inflation protection is automatically included in an LTC policy unless the buyer rejects it in writing. Within limits, a tax-qualified LTC policy lets the insured add premium payments to out-of-pocket medical expenses that may be deducted from taxable income. Please pause the audio and watch the video. You can restart the audio playback at any time.
Growth of the senior market and the oncoming retirement of the baby boomers, the need for long-term medical care and nursing care is huge and barely tapped. Long-term care insurance provides financial protection against the cost of medical services and nursing care associated with the need for long-term nursing care. And it includes care that includes diagnostic, preventive, therapeutic care, treatment and rehabilitative, and personal care. This lesson covers the basics of long-term care insurance, and there's a lot of detail that you're going to need to get your arms around. What I want to do is just spend just a moment talking about the difference between a qualified long-term care insurance plan and a non-qualified plan. Quite simply, qualified long-term care plans were created following the Health Insurance Portability and Accountability Act, or HIPAA, in 1996. The basic intent was to standardize the level of care provided through long-term care insurance policies so that consumers could be assured that the long-term care policy they bought indeed provided the coverage that they expected. Policies that meet the qualifications of HIPAA are deemed qualified long-term care policies, and as such, they qualify for some favorable income tax treatment. First of all, premiums paid for a qualified long-term care insurance policy qualify, we might say indirectly, for a tax deduction. And that is because the premiums paid can be included with other medical expenses, and to the extent that those medical expenses exceed 7.5% of one's adjusted gross income, it is deemed a deductible expense. A non-qualified long-term care policy is not eligible for that benefit. Second of all, benefits received from a qualified long-term care plan are tax-free provided they are within certain limits. Benefits received from a non-qualified long-term care plan may be taxable. But let's go back to the benefits received from a qualified long-term care plan and make sure we understand what that limit is. Quite simply, if the benefits received from a qualified long-term care insurance plan are of a true reimbursement nature, meaning they are reimbursing actual expenses incurred, then it's tax-free money. However, if the benefits received are what we call an indemnity approach, where it's a stated dollar value regardless of the amount of the cost of the care, and If that benefit exceeds the actual care, then that difference may be taxable income. This is explained in the lesson, and you want to make sure you get your arms around that and fully understand it. But understanding the difference between a qualified long-term care plan and a non-qualified plan is important, not only for your career, but for understanding what you're going to see in your licensing exam.
Okay, so here is the questions for this long lesson. Beth buys both a long-term care policy and chooses several riders for additional protection. Which feature does her policy automatically include? I think inflation protection. All right, which level of long-term care provides continuous 24 care delivered by licensed medical professionals who are under a doctor's supervision? Skilled nursing care or immediate care? I'm going to say skilled nursing care. Which type of inflation protection in a long-term care policy is recommended for insurers who are at least 60 years old? Routine inflation protection, compound inflation, simple inflation, original inflation. I'm going to say compound inflation. I'm not sure which one of those inflations. Which level of long-term care provides ongoing but not continuous care to address a person's condition and is delivered by registered nurses, licensed practical nurses, nurses' aides under a doctor's supervision? Intermediate care, maybe? All right, let's see how I did anyway. Oh, wow, I got one wrong. The one I got wrong was the inflation one. The inflation for people at least 60 years old in long-term care is the simple inflation protection. All right, so let's go back to this again. Beth buys a long-term care policy and chooses several riders. Which feature does her policy automatically include? Inflation protection. And I believe it's the simple inflation protection. All right, 24 care delivered by licensed medical professionals under a doctor's supervision is skilled nursing care. Which level of long-term care provides ongoing but not continuous care to address a person's condition is delivered by registered nurses, licensed nurses, and nurses' aides, which is called immediate care. And it's to address a person's condition, but it's not necessarily needed 24 hours a day. All right, I'm going to cut this off because it's already a long video, 22 minutes. Next one is group health insurance if you're interested.